Hi, we are here to present a summary of assets in our portfolio. Our assets consist of two now S&P 500 companies, a ETF, two assigned companies, two corporate bonds, and a 3-month US T-bill.
To summarize the performance of each asset in our portfolio, we first analyze the geometric and arithmetic means of rate of returns. While arithmetic mean is the average of periodic returns for the 65-month period for each asset, their geometric mean is the rate used in compounding over the same period for each asset. As shown by the table, simply looking at these two summaries shows that Lululemon seems to yield both the highest arithmetic means and geometric means of rate of returns.
However, when comparing over different risky assets, Sharpe ratio is a better method. Sharpe ratio measures the risk-adjusted return of investment products. We here use Sharpe ratio to evaluate performance of individual stocks and 3-month Treasury as our risk-free rate when assessing our 6 assets. From the table, we can see that TransUnion has the highest Sharpe ratio, which indicates that it is the best performing stock among other 5 risky assets. On the other hand, AM and GM returns show that Lululemon is the best performing stock. However, we would like to evaluate the performance of assets by looking at how much return is available for each unit of risk taken from them. Simply looking at return might be misleading because higher risk corresponds to higher return. Therefore, investors would prefer assets with higher Sharpe ratios. In this case, we would prefer TransUnion over Lululemon. Although Sharpe ratio is a better approach than AM and GM returns, it is also important to recognize its limitations. Limitations include that the Sharpe ratio is based on the assumptions that the return will be normally distributed, and future performance will be similar to the past. In addition, Sharpe ratio cannot differentiate between intermittent and consecutive losses, and Sharpe ratio focuses on volatility but cannot identify between upside or downside movement.
Even though both arithmetic and geometric means of rate of returns are used to summarize the performance of each asset, they are mathematically different, with arithmetic means of return always greater or equal to geometric means of return. As we can see from the table, when the rate of return is normally distributed, the difference between AM and GM can be estimated by variance of rate of returns divided by 2. Therefore, the difference becomes greater when more volatility in stock prices is involved. However, despite this mathematical difference between these two means, arithmetic means are often used as geometric means. People often compound using arithmetic means of rate of return. Since arithmetic means are systematically greater than geometric means, the more periods of compounding involved, the greater the overestimation in the returns is compared with the actual holding period of return. As indicated by the graph, the discrepancy grows as more periods are involved. Thus, with larger differences between the two means, such as EOG and Lululemon, we should use geometric means of rate of returns when compounding, instead of arithmetic means of return to prevent overestimation.
We then analyze the stock return by examining bid-ask spread and impact of positive market return on stock's return. Bid-ask spread is the difference between bid price and ask price. There are several factors that impact bid-ask spread, including liquidity, volatility, and the stock price. Talking about liquidity, higher bid-ask spread will be considered to be no liquidity with higher transaction costs. On the other hand, small bid-ask spread will be considered to be high liquidity with lower transaction costs. Volatility of a stock is a fluctuation of the price movement. When there are repeat changes, the bid-ask spread will be relatively wide because market makers will want to make profit from it. However, when volatility is low, there will not too much fluctuation on price and risk. The bid-ask spread will be small. Stock price will also affect the bid-ask spread, and it is related to liquidity. No stock price companies are often small or new companies. The value of the company tends to be low and least liquidity. Thus, no stock price tends to be higher while the bid-ask spread and vice versa. The average bid-ask spread of EOG is the lowest among other stocks. However, it has the highest variance among other stocks, which indicates that it has relatively high volatility. So the no bid-ask spread is not due to volatility. Therefore, the only explanation for such a no average spread would be high liquidity with high trading value. On the other hand, Lulu has the highest bid-ask spread, a relatively high variance, high returns, and average price. Therefore, it can be inferred that Lulu must have a repeat increase in stock price and increase in trading value. To gain deeper understanding on the stock movement and S&P 500 movement, a frequency table and probability calculation is concluded. TRU has the highest 77% positive return probability conditional on the positive return on the market, followed up by DET, Lulu, EOG with 68%, 66%, 65% respectively. It also relates that the return of TRU has the largest covariance with the return of S&P 500. So we can conclude that among these 65 months, when the market results in a positive return, TRU has the highest frequency to achieve the positive return. Even though TRU has the most time to acquire a positive return when market return is positive, DET has the biggest frequency to outperforming the market return. And Lulu obtained the largest holding period return, around 454%. However, the monthly frequencies of outperforming the market is the lowest. Therefore, it might be inferred that Lulu has a period of repeat increase, but the increase is not over a long period of time.
Other than risky assets, bonds are also important in a portfolio. The two corporate bonds our group have analyzed are XPO Logistics Incorporation and Carpenter Technology Corporation. Both of these two bonds are semi-annual level coupon bonds with a face value of $100. As XPO is sold as face value, it is a par bond, and Carpenter is a discount bond because it is sold at $99.85, which is lower than its face value. As bonds are publicly traded securities, the price of the bond is affected by a number of different factors. One of the most important factors that affect the price of a bond is the yield to maturity. Yield to maturity is the total return anticipated on a bond that is held until maturity given the price of the bond. And the bond's price and its yield to maturity is inversely related. If we want to calculate the price of the bond assuming it is bought today, which is February 18, 2021, a more specific YTM is needed than a published YTM, and it is obtained using Excel solver. The YTM we have obtained from solver for XPO is 0.0276, and the YTM for Carpenter is 0.0133. Using the solver YTM, the price of XPO today is $101.8, and the price of Carpenter today is $104.4. The published YTM on an annual basis is 0.0535 for XPO and 0.0223 for Carpenter. Thus, the absolute difference between published YTM and solver YTM on an annual basis for XPO is 0.0012, and the absolute difference between published YTM and solver YTM on an annual basis for Carpenter is 0.0039. We have also calculated the effective annual rate, annual interest rate, and annual percentage rate for the two bonds. XPO has an EAR of 0.0622, AIR of 0.0604, and APR of 0.0605, while Carpenter has an EAR of 0.0450, AIR of 0.0440, and APR of 0.0441. This indicates that XPO offers a higher return than Carpenter. In addition, we analyzed the holding period return for the two bonds. For Carpenter Technology Corporation, as of February 26, 2023, the HPR for the 10-year maturity is 55.29%. For XPO Logistics Incorporation, as of August 25, 2023, the HPR for the 7-year maturity is 52.6%.
In comparison, Carpenter technology has a slightly higher return but over a longer period. Thus, investors should balance their holdings accordingly.
In this project, we have mainly focused on analyzing individual assets using multiple approaches such as periodic return, Sharpe ratio, bid-ask spread, and holding period return. In the following project, we will look at creating a portfolio, comparing the performance of an equal weighted portfolio with a value weighted portfolio, and the benefits of diversification. We are also going to analyze the advantage and disadvantage of each portfolio, such as rebalancing. We would also compare our portfolio return with simply the S&P 500 return and determine if our portfolio methods are able to outperform the market.